All right, I'm gonna make this video kind of quick, but today entering the market. It's gonna open in, I think, 2 minutes. So I'm making a purchase order for 130 shares of SPXL, which is the triple leveraged S&P 500. I ran a quick testing on the method,
and for about 4 years to see what the return was, and looked like I was happy with the return. So again, I'm putting about $12,000, almost $13,000 into this with cash reserves of $13,000. And then the other purchase I made was for TQQQ or TQQQ, and I made an order for 1,000 shares, or 1,017 shares of that. So that's about a $47,000 to $48,000 purchase, again with $48,000 in reserve. And I did a quick back test on this algorithm, trying to figure out what would be potentially the worst point to enter the market. And I'll go ahead and also did a back test of 4 years. So I'm assuming that there's a 50% chance it's going to go up and 50% chance it'll go down. I really think it's actually higher that's going to go up, but I went with the default parameters for the AIM investment strategy. So I did it for both of those to be the same, 50% chance up, 50% chance down, even though I feel it's more like 100% chance up, and going from there. So we'll see if I'll be right on the hypothesis. All right, let me go ahead and show you quick back testing. All right, so this is the return for SPXL over buying at a high point and then keeping it till today. You can see that there was about a $50,000 return on this, and it never went below our initial investment of $90,000. This is traded on a weekly trade. This is TQQ, and you can see there's more volatility in TQQ. You can see our balance of $90,000, and we enter it and you get some great returns. And then TQQ basically takes a massive drop when the Feds change the rates. You can see we have cash for a while, which is in red here. And you can see our cash building up as we're selling at the peaks. But then when the stuff starts going on sale, we are completely spent out. So we miss this great buying time, let's say, for a while, and then slowly start selling as our stock price returns. But the good thing is we again ended up above our returns. Now I did notice that with TQQ, because of the volatility, again, this is me just changing. If I go from a weekly to a monthly return, we keep our cash a little bit more stable. Not by much, but we do, and our return's actually better because I think we capture more of the points because it's so volatile. We can get those trends in. You can see our cash goes up a little bit here, and the total value never really dips down very much, and then shoots right back up to 150. But TQQ is definitely a more volatile investment, but the good thing is it doesn't go to zero. But yeah, so our starting point was 44 and our ending point was 46, is why I chose this. So had we just maintained the same, we would have ended up right here. So you can see the return buying at the worst point, or not one of the worst points, ends up right back where we started. So not bad. I just kind of arbitrarily chose it from December to December to get the years also, which is 3 years of returns. So you made about a $50,000 to $60,000 return over 3 years, which is a great return versus being at zero had you just been a lump sum investor. All right, peace.